Okay, this is Dr. Herskowitz again, and now we're going to be talking about nonprofit corporations. This is a type of legal entity. It's covered very quickly in the book itself. Very few texts actually deal with nonprofits to the extent that I think they probably should. So much of this material will be different and more expansive than you find in the text. So it's important to listen to this video and look at the PowerPoints as well. Okay, the learning objectives on this is to show the forming of a nonprofit corporation. How do you actually form a nonprofit? And understand the legal requirements and the limitations of a nonprofit company, especially the limitations. We're also going to learn what UBIT is, unrelated business income tax, and how that affects the tax status of both the nonprofit corporation as well as any donors that may have donated money to the company. Okay, how do you actually form a nonprofit corporation? A nonprofit corporation is formed in the state that you elect, and you actually form a corporation, just a regular corporation like you would any other corporation. At that point, the board then goes and applies to the IRS, Internal Revenue Service, to be qualified under Section 501 of the Internal Revenue Code. 501c3, this is for religious, educational, charitable, literary, or scientific purposes. There's a number of other 501c types of classifications, but we're going to be only talking about the 501c3. The other types of nonprofits may not give tax deductions to donors and have other types of limitations. So we're focusing on the 501c3 corporation. And again, the nonprofit corporations are not formed at the federal level. They're formed at the state level, and then they get a federal income tax exemption under Section 501c3 of the IRC. One of the most important aspects of a nonprofit company is that there is no personal inurement. That means that there's no money paid to an individual disproportionately. It means that no special benefits go to an individual or a group of individuals as part of the nonprofit. Does that mean that a nonprofit may not pay salaries? No. What we're talking about is personal inurement, something that's above and beyond a reasonable salary. Think in terms of Southern Nazarene University. It's a university. It pays its professors, its administrators, people that work for the university. The key is that the salaries are reasonable and comparable to a similar position with a for-profit company. So what the IRS is looking for is for a company that is giving excess profits to individuals or sharing in the profits of the nonprofit in a proportionate manner. That cannot be allowed. Okay, a nonprofit must take all of its profits and return it back to the organization, and so it's used for future operations. That's why it is a nonprofit. It will make a profit, but that profit must stay within the organization itself. Operating a nonprofit corporation is done by a board of directors, often called a board of trustees. Not that different than a regular corporation that we've already looked at. But who elects the board? Are there shareholders? No, there are no shareholders because there's no shares in a nonprofit. It may have members, such as a church will have members that are part of that nonprofit. The board can be elected by the members if it has a member basis, or it can be a self-perpetuating board where the board members elect the new board members and they don't have any other members per se. That's true of a lot of charitable organizations where the board is basically running the organization and elects its replacement members as well as the chairman of the board. The nonprofit must observe all the formalities of a regular corporation. So what happens when you want to terminate a nonprofit corporation? Well, a number of ways it can be done. The directors can vote to dissolve the nonprofit. It can be dissolved by a court, such as a bankruptcy, just like any other company. If it is unable to pay its obligations as they come due, it can be forced into bankruptcy. And it can be dissolved by a state attorney general. If it's violating the nonprofit laws of that state, then the state will dissolve that entity. The important thing is that when the nonprofit is dissolved, the assets are paid first to repay any debts. All the remaining assets are distributed to another tax-exempt nonprofit corporation. Again, under this idea of no personal inurement, no individuals may benefit from the termination of a nonprofit corporation. So why go through all the trouble of forming a nonprofit corporation? Well, one of the key reasons, the same reason you form a corporation, is to protect personal liability. It also allows a nonprofit to enter into business and raise funds for charitable activities. Many foundations will want a nonprofit status, a grant, before they give any grant of funds. You can also solicit tax-deductible contributions as a nonprofit corporation. And as I said, the personal protection of liability for the individuals, and its protection from advocacy lawsuits. So, can a nonprofit run a business and make a profit? Yes, it absolutely can. Nonprofit does not mean that you cannot make a profit. It means those profits must stay within the corporation. But think in terms of universities. They run a business. They run universities and schools. Religious activities are for churches. The activities that are related to the nonprofit are the activities that that corporation is doing. And for charitable activities related to the charitable purpose. So all of these activities, the university, SNU, makes a profit every year. It needs to, so it can build up a reserve and be self-sufficient, self-perpetuating. And so it is okay for a nonprofit to run a for-profit organization. However, all funds must stay within the organization, and it's allowed to have employees, as I said before, so long as they are reasonably paid. So a qualified nonprofit company does not pay taxes on its related income. This exemption can be lost or mitigated if the nonprofit company has too much unrelated business income. I'm going to be talking a lot about that. Tax on an unrelated business income is called UBIT, Unrelated Business Income Tax. The test to determine whether a fundraising activity of the nonprofit will generate UBIT. Remember, UBIT is in fact taxable income to that non-taxable entity. So what type of activities can a person do, that a company do, that will in fact generate UBIT? It must have the activity must be a trade or a business. It's not just fundraising. It's the sale of goods or services that is regularly carried on, and read this as frequently carried on, and that is not substantially related to the purpose of the entity. This is the area that most people have the biggest trouble and misunderstanding with. Raising money to support the activity of the church or the charity or the educational institution is not related to the purpose of the organization. Merely because the funds are used for the purpose of the nonprofit does not make it substantially related. In other words, charging tuition for classes is in fact related to the purpose of the entity. Going off and having an annual banquet to raise scholarship funds is not related to the purpose. The university is not in the retail food industry. And so the activity must be substantially related to the purpose of the nonprofit. This is what we call the three-prong test. Very important. You do need to understand that it is a trade or business that is regularly carried on and that is not substantially related to the purpose. All three prongs must be present if the IRS is going to be able to charge UBIT. Okay, regularly a trade or business, sale of goods, the purpose is to make some kind of a profit. Is a church car wash a trade or a business? Yeah. They're washing cars just like not a for-profit company might do. Okay, regularly carried on. Regularly carried on means the frequency and continuity compared to similar activities. Carried on a few times a year is not regular, even if it's done at the same time. If you have a banquet at a certain time every year, it's not regularly carried on, because regular really means frequent, not in the same time period each year. If it's done for 1 or 2 weeks, that is probably okay. Once a week throughout the year, however, the IRS has considered that regular. It's a factual question that's looked at in each case by the IRS. So is an annual fundraising banquet done every 4th of July a regularly carried on activity? No, it is not frequent. Once a year is not frequent. Don't get caught up on the fact that it's regularly on every 4th of July. Not substantially related to the purpose of the entity. Mere profits to benefit the purpose does not make it a activity related. The IRS looks to the purpose of the organization. Selling fireworks to send kids to a summer camp, is that related to the purpose of the church? Well, people look at it and say, oh, well, you're sending kids to summer camp, that's the purpose of the church. Yes, that's the purpose, but selling fireworks is not the purpose of the church. Therefore, selling fireworks is not related to the purpose of the church. Some organizations can have split, such as a bookstore and a museum. Those items sold related to the museum can be related activities. Maps, tchotchkes, souvenirs, things like that would be unrelated. Cash registers today are all computerized, and they can designate what sales are related and what are not. So you can actually have a split between related and unrelated and UBIT from the same activity. There are exemptions to UBIT. If the work is performed by volunteers, selling of Girl Scout cookies, those are all volunteers selling them. Goods to be sold are donated, thrift stores. Here's a tricky one for you. What about if the thrift store buys used clothing from the Salvation Army that had them donated? Well, they bought the goods. That then is not donated for the organization that is in fact selling it. Bingo is specifically exempted so long as it's not done on a commercial basis and generally done on the premises with cards. Also, income from rent and from certain investments are not UBIT because of the specific laws that exempt those types of activities. UBIT becomes substantial, then it may appear that the purpose of the nonprofit is changed from what its charitable or religious purpose, and it may be a business with some charitable activities. So the entity would be taxed on all of its income if UBIT becomes too much. Donors also would then be not able to deduct their contributions for tax purposes. These types of cases usually take a couple of years to resolve. The IRS may say retroactive to last year, it was not a charitable activity, and the donors would then have to go back and refile their income tax and show that donations were no longer to a nonprofit. We have a concept called feeder organizations. This is a organization that carries its for-profit activity in the form of a separate legal entity that is taxed. And so that's why it's called a feeder organization. The entity pays the taxes, but the owner of that entity is a nonprofit, and it does not have to pay any taxes on the dividends paid by that. We have a case of that with a church in New Jersey. Political campaign activities absolutely prohibited. 501c3, you may not support a public official. The violation will result in the loss of tax-exempt status. However, you can do educational programs so long as it is not biased toward a single party or a single candidate. Individuals may make comments as individuals so long as they're not representing the organization, but you better be careful on doing that because some people are so closely identified with their nonprofit that their endorsement may be construed as endorsing that candidate. Okay, that's about nonprofits, a very important aspect of legal entities, and you will be expected to understand this on the quiz, and you have some written assignments as well. Thank you very much. I'll see you with the next video.